welcome to ShareTrek. This is Raj here, and today we are doing the third episode of our series on investing in India. And as always, I have my friend Kumar here to give us all the information. And today's topic is going to be the second instrument that you could use for investing in India, and it's going to be fixed deposits. So let's get started. So welcome, Kumar.
Thank you. Thank you for inviting.
So you're going to educate us about fixed deposits in India, the various types, etc. So take the floor, please.
Yes, my monologue starts now.
Yeah.
And as usual, a disclaimer, please consult your personal financial advisor before you take any investment decision. We are here only sharing our understanding, our knowledge, because we have used these instruments. Based on that, we're sharing our knowledge. And it's no advice in anything. It's your risk assessment that you take and use. Now, coming to the product, fixed deposit or term deposit as we call. And this basically for any asset class, like we talked about gold, everybody understands what gold is. It's a precious metal. Similarly, we need to understand what is a term deposit. A term deposit is the simplest term is that you are lending somebody money. It's as simple as that. So for example, if your friend borrows from you and he says, I'll give you the money tomorrow, that means you are putting a term deposit for a day. If you say, okay, return it to me without any interest, you're taking it without any return on it. So the zero is the coupon rate or the interest rate on that. And similarly, any term deposit, any lending you do, you are expected to be paid for the time value of that money that you're giving. So they will be giving you a rate of interest, which is at least the basic cost of that money for the borrower. Basic cost. But in case of term deposit, it depends as to what is the kind of risk you're taking. You need to understand who you are lending to, because there is a premium on lending to lower risk entities. There is a higher premium on lending to a bit higher risk entities, and so on and so forth. And the lowest risk in any country, the term deposits are available in almost all countries. The lowest risk that any country looks at is the sovereign risk, which is the government. So if you're lending to the government, you know that the government can mint the money and pay you back. So the chances of default is zero.
Yeah.
So you will get your money. That's as simple as that. So you will, the lowest rate of interest also is in government deposits. So when you do a deposit with government as in any form, it becomes a lowest interest rate possible. So any country you go to, there also it is the same story. Now, coming to where all you can put deposits in, especially in India, because we are focusing on investment opportunities in India. So the most common, known way of putting deposits is in banks in India. So you have different types of banks. You have nationalized banks, you have some commercial banks, you have private banks, you have cooperative banks. So cooperative banks by its very own nature and articles and also the articles of association of creation gives you a bit of a more small percentage higher interest rate compared to the other types of banks. Now, when you're giving to a bank, a term deposit is not an account. Many people mistake that I have a deposit account with this particular bank. This is not an account. It's a contract that you have with the bank. That's why they give you a deposit receipt. They don't give you a passbook for your deposit because it's not a running account. So they give you a
sense.
receipt that I have a contract with you. You have given me this much money. I am willing to pay you this much rate of interest. And this is for a period of n number of days. And at the expiry of that date, I will pay you principal plus interest, which accounts to this much money. And it is signed by the bank and given to you. And when you go and claim that money, they ask you to sign in the reverse so that the contract is closed and they pay you the money and the topic is closed. So that's a contract. So you're having a contract with the bank that you have lent money to the bank, and the bank is free to do what it wants with it because you're lending to the bank, not to any other borrower or depositor or any other person within the bank, but you're lending to the corporate legal entity that is the bank. And for that, the end use of that funds, you have no control over. They can invest it in a high risk borrower or a low risk borrower. They can do whatever they want with it, but you don't have a control over it because you're signing a contract with the bank to give a deposit. So what are the risks involved in keeping a deposit with the bank? As you all know that banks are also corporate entities and they have the risk of bankruptcy. There is a risk of bankruptcy with banks. And what happens with banks is when they become bankrupt, you had the famous cases now in the US of two banks which collapsed. Um, but the basic issue that these banks collapsed was they didn't have deposit insurance. So the monies that were kept with the bank could not be returned. No, they were not, if they don't have the money, there's a run on the bank, they don't have the money and the liquidity available, they cannot pay the depositors back.
Yeah, for
And
them, yeah. For SVB Bank and all, what happened was that they had put all the money that they got into the treasury bonds, and they had bought the treasury bonds in a increasing interest rate environment. So as the interest rates increase, the face value of the bond remained the same, but the market value of the bond dropped. As a result, many depositors felt, many customers of the bank felt that the bank may not be able to pay them back, so they wanted to demand their money at once. When they started demanding the money at once, it forced SVB to sell at a loss to fulfill the demand for money. And in this process, the bank became insolvent. But if the clients had not rushed after it for the money, the bank would have survived because they did what they thought was right at that time by putting money in US Treasury bonds, which is the safest. But as the interest rate goes up, the market value of the bond goes down. And that's what took a toll on those banks. And the Federal Insurance Corporation made some adjustments to pay back people. But you're right. I mean, when there's a run on the bank, FDs are a casualty. Yeah.
they are a casualty. Plus, the federal insurance was asked to take care. The biggest problem these banks had was when they went into the bankruptcy, they didn't have insurance cover
Right.
for the deposits.
Yes.
Now, in India, the rule till a few years back, it is mandated by the RBI that any bank has to have insurance.
Right.
And this is from a government entity, which gives the insurance. And this is for depositors insurance, which covers all types of accounts and deposits you have with the bank. So it includes everything from your savings bank to your current account to your deposit accounts, all of it put together against one customer name. They have an insurance available. So it used to be 1 lakh rupees a few years back, which was recently after a bank collapse, and that 1 lakh was found to be very insufficient. It has been increased to 5 lakhs.
Okay.
Now, this is
5
the
lakhs
cost
per person, per branch.
per customer, per bank, per bank, not per branch,
Per bank.
per bank. So basically, what happens is when the cost of this insurance is borne by the bank, it is passed on to you as part of the cost. So if you could have got 8.5%, they will give you 8.25% because 0.25% would be their cost for the insurance.
Right.
So you need to look at it from that point of view. So in most of the banks, almost all the banks in India, when you put a deposit, just remember that it is covered for up to 5 lakhs. So now if you have 25 lakhs to invest, I would recommend you put the deposit in 5 different banks.
Right.
So
Makes sense.
or each of them are covered because each bank, each customer is what the coverage is about. So even if one of those banks go bankrupt, you still have 5 lakhs available from the insurance. Though it's easy to say that they have an insurance, it takes a bit of a time for the entire process to get over and your money is to be released in due course. And you lose a lot of interest for that period when the whole process takes place. It can take up to 1.5 to 2 years or even 5 to 10 years in cases.
Right.
It depends on the complexity. So you have to be clear that you don't put all your eggs into one basket. So if you want to invest in a product like deposit and you're comfortable investing it in a bank, then you need to be sure that you are investing it within the risk level that you can take. For example, if you have a higher value of amount, you can even consider putting deposits in different banks because banks allow you to keep deposits with them without having to have an account. You can do your KYC, all of the requirements, but keep the deposit because you will be transferring the money or paying by check, which is already having a audit trail. So it's not such a big issue that you need to open an account, then only you can keep a deposit. So you can have a deposit with any bank at any point in time. And the next part that comes about deposits is, which is applicable to most of the other cases also. These are all generic things which are applicable to term deposits. We will come to other aspects of which term deposits, what are the kind of returns you're getting and all those things. The other thing that you need to understand is when every bank has a weekly ALCO meeting and they come up with the ALCO report, which is called basically asset liability management. So in that, what they do is assets are basically what they have left, liabilities are what they have to pay you. The deposits you have with them is a liability for them, it's an asset for you.
Yeah.
This is the confusing part of accounting. But why do they do this? Because there is a specific table they have, which in that looks at tenor management, tenor mismanagement. What is tenor mismanagement? Because in India, you can keep deposits from 7 days to 10 years and more, depending on which bank is offering you that kind of a tenor. Up to 5 years, almost all banks offer. That's not an issue. But some banks also offer up to 10. Now, they take deposits from you at these different timelines, 7 days, 1 month, 3 months, 6 months, whatever it is. They lend. So they lend short term, they lend long term, they lend term loans, they do a lot of other things. They have uh, some fund-based products which will have a very short period of gestation. For example, you take credit cards in that case. Credit cards, every month you pay it back, technically. If you're using the 10%, fine, at least 10% is coming back. But then the bank has lent it to you for 10 days or 40 days. From the time you have used that money till the time that you repay it, it's a short term. Similarly, they would have lent for constructing a full plant and machinery to be set up and everything for a big industrial house. That would be a tenor, could be something like 15, 20 years. So they look at how many of my deposits will mature in the next 5 days, 10 days, 15 days, so on and so forth for the 10 years, 15 years period. When am I going to get my loans back? I have lent these loans. When am I going to get it back? 5, 10, 15, 30. All those timeline, they do an analysis and they realize that, okay, now I need funds because my deposits will be maturing. This chunk of deposit will be maturing in the next 3 months. And then I need money for that. And I need money which will remain with me for say 1 year or say 2 year or 3 year, depending on how their loan book is saying, how long they need that fund. Because when somebody puts a deposit, it will mature and it will go out. The funds will go out of the bank. You cannot expect it will be renewed. So technically, they need to project for that. Why is this important? Because this setup is different for every bank. It depends on the bank's loan book as to when loans are maturing, when the funding is required, when the deposits are maturing, what is the structure and composition of their deposits and their loans, that this table will give a result. Now, based on this result, every bank will have a different rate of interest for a different tenor. So if a bank needs money, the most critical requirement of the money is something like 6 months down the road, they need it for another 4 years. Then the term deposit rates that they offer for a 5-year term deposit will be the highest because it's the most critical requirement of that. So they want depositors to put deposits for 5 years, because if they put that deposit for 5 years, then they know that they have managed that liability requirement of 5 years by getting the deposit, which is funding that lending that they are doing. So when you're putting a term deposit, you should analyze what are the rates available for different tenors from different banks, so that you can make a conscious decision as to where is it that you are going to get the best of the return. And term deposit is just money, so it doesn't really matter as long as the bank is regulated and it is well in the public domain and doing a decent job. You can easily create a term deposit with them. Number one. Number two is, in case of term deposits, if you it's for a fixed tenor, so you cannot actually access the deposit during that tenor. In India now, you have deposits which have additional option being available, saying that you can break this deposit before the term, or you cannot break this deposit before the term. These are the two options you have. So obviously, the rate of interest on the deposit that you are not allowed to break is a bit higher. Second, the rate of deposit on the one deposit which you can break before maturity is slightly lower. Plus, what happens is when you break the deposit, they will pay you interest only for the period that you have kept the money at the rate that was applicable when you put in the money for that period. So, for example, you have put a deposit for 5 years at the rate of 8% on 1st of January. And on 1st of January, the rate of interest for a 3-year deposit was, say, 5%. And if you break your deposit after 3 years, not keeping it for the full 5 years, then they will calculate the interest payable to you at 5%, and they have an option to also put a penalty on you because you have not kept the contract for the period that you had contracted with them. So there can be a slight penalty also included in that. All these erodes your return. So you need to be very clear when you're putting the money into deposit as to how long can you keep it. Even if the best interest rates are at a tenor which you don't want to put the money in for, then you need to look at the next tenor where you are comfortable keeping the money blocked for that much time because you don't have the liquidity of it till that point in time. That's one part of it. Now, deposits also come in two different ways. One is you can have the entire interest compounded and paid back to you on maturity, or you can take that interest out on a periodic basis. So these are the two different options that you get when you keep a term deposit with banks. Now, what is the benefit? What is the loss in case of these two options? If you go for interest with maturity, what happens is the interest that you earn gets compounded every quarter or every period, and you get the benefit of compounding. And on maturity, you get the total capital with interest in one shot. So, for example, if you have kept something like 1 lakh at 10% for 1 year, then on maturity, you will get that 1,10,000 plus compounding benefit that you will get. You will have to put a calculator to calculate that and it will work out. So that's the benefit you get. What is the benefit of taking the interest out? Interest out is if you want regular income, regular source of income, then you can put a lump sum as a deposit and you can say, I want monthly interest payout, or I want a quarterly interest payout, I want a half yearly interest payout. Or if you're putting for a long tenure like 5 to 10 years, you can say, I want an annual interest payout. So that every year you get the interest out and your capital remains the same. So given inflation, the capital will erode because with every passing year, inflation eats away your value of your money. But the interest that you're getting on that period that you have asked for, that you can always reinvest at a higher return product or an asset, or it can meet your regular requirements for which you made that deposit in the
As a
first place
retiree, yeah.
as a retiree. Now, what you need to understand is when you take an interest payout, there is always this discounting that the banks do, saying that, for example, if they say we will pay you 9% per annum interest, in that case, if you're taking it on an annual basis, you will get 9%. If you're taking it on a half yearly basis, you will get something less than 9%. If you're taking it on a quarterly basis, you will get still lesser than
Even
what you
less,
get
yeah.
on a semi-annual basis.
Makes
If you go
sense.
on a monthly basis, you will get a still lesser amount. This lesser amount will be very fractional. For example, if 9% is the annual rate and you take monthly, you may get something like 8.85,
Right.
which is the discounting that they do because they don't have the money for that period, though it is being generated and payable.
Right.
So these things you will need to keep in touch, keep in mind when you're looking at a deposit. Number three that you can look at it is, we talked about the ability to prematurely withdraw the deposit by breaking the deposit, as they call it in common language. So there is another option also. Almost all the banks offer you a loan against the deposit. The deposit acts as a collateral and they will give you a loan against it depending on the kind of haircut that each bank has based on their own risk management practices. It can go up to even 90% of the deposit value. And then you repay that loan on a periodic basis, and it's charged at a differential rate. For example, if you have kept a deposit at 10%, the rate on the loan they offer you could be 12% or 13%, depending on their prime lending rate and what is the kind of margins they have, intermediation cost. 2 to 3% extra they will take and they will give you that money. So you also can have liquidity instead of breaking that deposit. So it's up to you to think as to which is the best suited action at a point in time when you have to
Yeah.
take that decision. But this is how the product works. Now, having talked about banks, saying that this is where this is the most common counterparty with to whom you lend as an individual retail investor if you want to put a term deposit. Now the same money, there are other term deposits also, options are also available for you because it's your money. You have a kitty of say 1 lakh. It's your choice whether you put the entire 1 lakh into a bank or you put 10,000 into a bank or 10,000 into some other counterparties and so on and so forth. So what we are going to tell you is what are the counterparties available for you to lend or keep a term deposit with. So if you look at the first most commonly adopted counterparty in India, it's basically the post offices. It's a government savings scheme because the government always likes to have savings promoted within the economy in India, given the economic philosophy of how the country has been set up. They want savings to be generated because it allows them to have the funds to invest in development. Because you can borrow everything is fine, but there needs to be funds available in liquid form with the banks because banks lend.
Right.
Banks lend to other banks, banks lend to the government, banks lend to individual people. So as long as they have money, they can lend. Similarly, these organizations also give the money. It's a government. It's given to the government. So the government can deploy this money in the initiatives that it wants to deploy. So
Right.
this way, savings is encouraged as a habit. Saving is an habit which is encouraged by the government, and this is true since our childhood. From our childhood times, there have been savings have been encouraged by the government predominantly. So basically, these post office deposits and give you a better rate of interest. They give you a much better rate of interest than the banks. But here you don't have the tenor benefit of 7 days and 3 months and 6 months, etc. They allow you deposits so for fixed tenors which they have, and they say we have 1 year, 3 year, 5 year. These are the rates on it, please. And the rates are fixed by the government. So it's not something that, like in case of banks, when we say that the rates are fixed by government, what is the implication of it? A government doesn't fix it on a daily basis. It fixes it purely on an annual basis when they come out with their budget discussions and everything proposals. At that time, they say, okay, for post office deposits, given the nature of the economy at this point in time, we will increase or decrease the rate by this much, and or we will keep it static as it is. So it is an annual revision that you can expect in case of post office savings. But any emergency comes in, they can always come out with an ordinance and change that. That risk remains. But generally speaking, it doesn't get changed more than once a year. Whereas in case of banks, banks have the freedom to change the rates at any point in time. So what happens is if you put a deposit with the bank, the rate of interest is fixed on the date that you have put the deposit in. No matter what changes happen, you will get that rate of interest because it's a contract that you have signed with the bank. As we have mentioned, you have a deposit receipt which says you gave us money, this is the rate of interest we'll pay you, this is the amount it comes out to on maturity, this is what we'll pay you. So it gets fixed. But if you go 1 month later to the bank for the same tenor, the rate could be different because it depends on their asset and liability book as to how they want to price it, what is the pricing they are comfortable with at that point in time. They may come out with some very interesting rates only for a small period of time of 3 months. They may say, normally my 90-day deposit or 1 year deposit is priced at 6%. For the next 3 months, we are giving 7.5%. So if something like that comes, you need to have liquidity. Okay, you can then put a deposit for that period because it will be better than the market rate that you would get. Now, having said this, we come back to the post office, and there you give the money to the authorities. They will give you a receipt that can always be used as a collateral to borrow from banks also, and you can then give it back on the maturity date, and they will pay you the money. In many of these cases, you don't have the periodic interest withdrawal options. It is only on maturity that you will get the money. But the rate of interest is always better than what the banks offer in most of the time. But given the fluidity of the bank rates, there could be a small period of time when the bank rates are better than the post office rates. But it is not a norm. The norm is the post office saving rates are much better. Now, this is because the government wants to encourage savings. The government wants people to save with them so that they have the access to those funds to deploy. Now, there are other counterparties to whom you can lend, and these are a bit more riskier counterparties, and you need to be clear as to what is the level of risk you're taking. Every corporate can borrow either from banks or they can also take deposits from customers. This is common practice. If they are allowed to do it, every organization is allowed to do that. They are allowed to borrow because most of the organization put some capital, they borrow some money, and then they deploy this whole thing in their entire manufacturing or service or whatever process they have in order to generate revenues. Only capital is not sufficient for them. They will need money for working capital, for other things, for asset building, all of it, they will need money, and they cannot keep on raising capital for that. So usually there is a ratio which tells as to how much of capital the company has, how much of debt the company has. It shows the health of the company. More the capital, it is considered healthier. More the debt, it's considered riskier because majority of the business is being run on debt. So that's not healthy for a company. So debt is something which companies raise, and depending on their credit worthiness, they will price that debt. So in India, if you look at it, you have corporate deposits available from many corporates. The best of the companies offer corporate deposits. You have companies like Tata's, you have companies like Reliance, you have companies like Shriram. All of them offer debts. Even public sector organizations offer deposits. So you may have something like Power Grid Corporation offering a deposit. So all of these deposits are available where you can put your money in and they promise you a rate of return. And on that basis of, as per their terms, similar to the post office one, they will have their terms of how they want to borrow. Because whenever they're offering a deposit with a particular rate, it is meant for something that they have in mind. They may want to put some asset, they want to buy some plant and machinery, or they may have some immediate requirements of funds which they need to meet up with raw material, or they expect the prices to go up, so they want to invest in raw materials. Any of it could be their reason, but depending on the duration of money they need, for which they need the money, and the criticality of the need, they will price that deposit. So they price the deposit. You don't have a choice of pricing the deposit, though you are the lender. They will price the deposit, saying that I am offering a 1-year deposit at XYZ rate. And they can give you an option saying that this will be paid on maturity, it could be paid half yearly. It is up to them as to whether they want to pay it in piecemeal, they want to pay it the whole thing. It's up to them. It's totally their choice. Now, what happens is these companies can go bankrupt. They are not as regulated as a bank. They are not a government entity like a post office. So basically, these are corporate companies. So any corporate company can go bust at any point in time. Yes, among the corporates also, if it's a public sector undertaking, it's a private sector undertaking, the public sector undertaking will have some level of government support. So it's a less risky compared to the private sector undertaking. Now, so the rates that they offer will reflect the level of risk that you would be taking. And you should be comfortable taking that risk, because there have been several cases where companies have gone bankrupt and the deposits have not been repaid. Because just remember, 99% of the time, your term deposits do not have any collateral.
Right.
It's a clean lending that you're doing. There is no
Unsecured.
collateral.
Yeah.
Unsecured lending. So basically, there is when you give a term deposit to the bank doesn't say, okay, these are the 5 things which I'm giving it to you, that in case I'm not able to repay it, you can sell this and get it. Nobody does that. In case of term deposit, it is without collateral borrowing by the entity. And you are lending it without any collateral. So these corporate entities will price it accordingly. And depending on your risk appetite, your understanding of the company, for example, it's a big company and you know that it has been in business for nearly 20 years, and then you do an analysis and say, okay, for the past 5 years also, it has been consistently growing, but you need to do that due diligence when you put the money into a corporate deposit. Now, your corporate deposits would invariably give you a much better rate of interest compared to both the banks as well as the post office. For example, as of now, the interest rates for bank deposits are in the range of anywhere from 5% to 7.5%. In case of post office, it is from 7 to 8.5%. In case of corporate deposit, it is in the range of 9% to 12% or even 14% in some cases.
Wow.
So that is reflective of the level of risk you will be taking. So that's how these are the various avenues for you to put in term deposit.
Got it.
Now, what are the tax implications for it? The tax implication for term deposits is you have a fixed rate of return that you know you are going to earn during the year. So that interest is taxable for that financial year when it is earned. It depends on your accounting basis whether you're doing accrual or you're doing cash. So when you file a return, it depends on your accounting basis that you will account for the interest, and the interests are invariably they have a tax deduction at source. That is how the government has done that, irrespective of what, as long as the interest that you have earned exceeds 10,000, they will start deducting the tax on source. So what the interest you will get will be tax deducted, and you are expected to file a tax return every year because you have earned money, and you have the tax return filing is to reflect the money you have earned, not the tax deducted. So basically, you will show that this is the amount I earned. This is what my tax liability will be for this level of earning, and I have already paid this much of tax, which is where the TDS comes into play. And if you have paid more tax, you will get a refund. If you have paid less tax, you have to pay the tax. So this is how the accounting and the tax implication will be, and the interest from these deposits are taxed as per your slab. As per your taxation slab, it will be charged. So this is how term deposits work.
Right.
And the idea, invariably, what we have seen historically is that the term deposit rates are always below the inflation rate. So keeping your money in term deposit, yes, you're earning money, you're getting money, but it's still eroding. For example, if you have 1 lakh and 7% is the inflation rate, then if you had not put a term deposit, you would have lost 7 rupees at the end of the year. But if you have put a deposit, you may get up to 6% maximum. As of now, the rates of interest are high simply because the inflation rates went up. Inflation rates went up to 7.5 to 8. So they had to give a better rate of the interest rate fiscal policies that were done by the central bank, forced their rates to go up, and they then started giving higher rate of deposit because their borrowing rate was also higher. That went up. So they had to give a higher rate of, for deposits. And that's the reason why the interest rates are currently higher. But this is a small period, window of time where your deposit rate that you get for, say, if you have put a deposit for 3 years now, I can assure you that only for the next 6 months, your deposit rate may be higher than the inflation rate. The remaining 2.5 years, it will be below the inflation rate.
Yeah.
That's how the whole thing works. So it's a small window. So you can look at you can consider deposit as long as it is a short-term liquidity you have, liquidity need you have, because you don't want to put it. For example, if you invest in some shares or you want to invest in some mutual funds and other products, it is long-term. You are looking at a 3-year to 5-year horizon, and you don't want to disturb it on your own because then the returns will be impacted directly. So if you want to keep some money only for the, you know that you need the money in the next 6 months, 1 year or 1.5 years, then deposit is a good instrument to hedge yourself against inflation by putting it in there for that period of time and making sure that given the tax cut that will happen on that, your money is doing something instead of being lying around just like that.
So that was a nice summary of all the term deposits, Kumar. You did a lot of heavy lifting today, and you have been talking about all these things in detail. So I'll just summarize as always for our viewers. So you have term deposits, and as Kumar said, your term deposits are with different counterparties. The most common counterparty happens to be a bank. Among the banks, the cooperative banks give you a slightly higher interest than the regular banks. And the banks also, when you're going to put your money into deposit, it's better to do a bit of shopping among banks, because different banks have asset and liability books that are so different from each other. So you may find that some of them will have a very attractive rate for the term of your deposit that you want to make as compared to some other banks. So do not forget to do a little bit of shopping around to see which bank offers you the best rate for your tenure. Having said that, banks have got deposit insurance to the tune of around 500,000 rupees per person per bank. So if you have a large sum of money above 500,000 to invest, then go to multiple banks, not exceeding 500,000 in each of those banks per person. That way you'll be covered and you'll be absolutely safe. And then, of course, Kumar mentioned about corporate deposits. So there are various corporate entities as well as public sector entities which are giving you term deposit options, which would range from maybe 2 years, 3 years, and 5 years in term. They give higher interest. Higher the interest, higher the risk. So look at the quality of the company. The better the quality of the company, the more stable the company, the less interest it will provide. But you'll have stability and security of your principal, and you'll also get assured returns on an ongoing basis. So you have to look at your risk appetite when you go for corporate deposits. So that's another piece of information we got from Kumar. So if we put it all together and look at it from an inflation perspective, generally bank deposits will pay you interest rate which is slightly below the inflation rate, which means that one of the advantage for you by keeping your money in fixed deposit, if you don't have any other avenue of investment, is that you save at least a good portion of the inflation that you would have lost. So if the inflation is 7%, you would have lost 7% value of your money. But if you had kept it in a fixed deposit in a bank, maybe the bank gives you 6.5%. So you just lose 0.5% of value of your money. So that's a very defensive ploy. As you get older, as you are less risk averse, you could go for those kind of things. And that's a small compromise to make. But if you are young and if you want higher returns, if you want to compound it faster, maybe you go for corporate deposits with some blue chip company, or maybe a little higher risk. It all depends on your risk profile and risk appetite, and a financial professional will be able to guide you on that. So please do take advice of your certified financial professional who is qualified to help you with that. We have just shared with you all the information that we know. And Kumar, having said this, what is the next instrument we are going to talk about in our next episode?
We can talk about bonds, which are very
Bonds.
closely related to deposits,
Okay.
but they are a different instrument. So I think we can give a small episode on bonds.
Yes. We always try to do a small episode, but you have such a wealth of information that when you get into the flow, you have a lot, and our episodes are around 38, 40 minutes. And I think it's value for the viewers. You can always rewind and have a look at the part that you have any doubt about. You don't have to go and ask somebody. If you have a question about fixed deposit, just rewind this episode, have a look. Your answer will be somewhere in there. We have been very comprehensive in covering it. So friends, I hope you liked this episode. And if you did, please press a like out there. And also, if you're not yet subscribed, please subscribe and help us grow this channel. And of course, big thanks to Kumar for continuing to appear in our channel and give us all this information. And also thanks in advance for the next episode on bonds. So friends, if you don't want to miss out the other episode, please press the notify button so that you get informed as soon as we deposit a video into our channel. And you can have a look at it at your leisure, but you will know that it's there. With that, my friends, I'd like to bring this video to an end. Thanks and have a great day. Bye for now.